From Washington, this is the HPS Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Hello, you're listening to the HPS Macrocast, a special edition of the HPS Macrocast. You're hearing this on Friday, November 29th, the day after Thanksgiving dinner. So I hope you all had a wonderful Thanksgiving, lots of turkey, lots to be thankful for with your families, and maybe markets and other things too. But we're pre-recording because we want to be home with our families too. But we want to make sure that you got a Macrocast this week. And the thing we thought about doing, because if you're not, and maybe you're listening to this, on your way to the mall to catch those Black Friday deals. And so John Fagan and Brendan Walsh here from Markets Policy Partners, our regular trio here in the DC office, and we have a guest with us this week. And Brendan, why don't you introduce our guest for us?
So this is a good friend and former colleague, Matt Dell Orfano, who not only covers consumer stocks and kind of has very interesting insights on that, but he's actually the guy that knows why it's called Black Friday. So Matt, why don't you explain to us why it's called Black Friday?
Because Black Friday has for years been a turning point for retailers in the space. So when you're a retailer, you have this terrible value proposition. You have to have these stores and people and sell things, and you lose money pretty much until the end of the year. And at the end of the year, your accounting turns from red to black. So that's the genesis of the actual term. But of course, things have changed, and there's a lot to talk about what's new and what's different given online retail and a whole bunch of different changes that have happened in recent years.
Exactly. That's why we thought this would be a very interesting kind of podcast where, usually you eat your dinner and then you take a nap and then you wake up at 4 o'clock in the morning and you go shopping. But now we have this thing called Amazon. So how does that work?
Is Black Friday, is it so you alluded to a little bit, do retailers still think about it the same way?
Sure. So absolutely. Look, at the end of the day, your holiday season is a massive period for sales. So there's a ton of them, and a lot of people are willing to pay full price for things. So when you're a retailer, you think about if you buy 100 sweaters, you think about, hey, I'm not going to sell 100. You don't plan to sell 100 at the full price. You plan to sell a couple at the full price and a whole bunch on markdowns and various sales. So a lot of that tends to disappear around the holiday season when people are in a hurry to get a gift. And the result is they actually make more margin dollars even on selling the same number of units. So it's still a very important period for them.
Actually, because I think of Black Friday as discount day.
Sure.
But it's actually the opposite, right? It's actually the day that you can capture people who are going to pay for some things full price.
There's loss leaders, and of course everyone runs and tramples one another for whatever they can get in terms of sales. But while they're in the store, they tend to buy a lot of other stuff across categories, and retailers make a lot of margin on that. So it's extremely important still.
And do they limit the amount of products, especially the hot ones, that they're discounting? So here's
Sure.
50, and then when those 50 are bought, it's over?
So yes and no is the answer to that question. Now, historically, it used to work that way, where they would, this similar to the supermarket putting hams on sale or whatever to drive someone, or eggs are marked down to somewhere where you lose money on them to get people to come in and buy milk and shop in your store that week. Retailers used to have a certain allocation of inventory that they would throw to the crowd by basically marking it down. Now, that is still the case, but what's very different these days is the vendor participation. And so I'll talk about stuff we all know. You all want a fancy cell phone or a new TV from Samsung. Let's just use Samsung. What happens now, and I think you can probably best visualize this if you think about going to Best Buy. Best Buy used to be a whole bunch of stuff, a whole bunch of people, and it was kind of Best Buy decided what was what. And now when you go in there, there's sort of a mini Microsoft store and a mini Apple store and a mini home video store and a mini Verizon store, right? So the vendors are basically paying Best Buy for that space.
That's fascinating.
What they're also doing is paying to help drive traffic by giving the direct discounts. So if you look, I think Walmart's promotion on certain Samsung cell phones this week, and I believe I have the number right, it's about $450 in gift cards from Walmart just to go buy a Samsung S10 or whatever the new one is. And what's really going on is Walmart and Samsung have come to an agreement, and Walmart said, I'm going to put this much towards it. Samsung says, I'm going to put this much towards it. And they are driving other sales by having them, remember those full price sales we just talked about? Right. By having people have those gift cards in hand. So Walmart says, I'm going to have a margin uplift of X. Samsung says, I'll take Y. They split the difference, and you think of it as marketing costs. Rather than spending it on a Super Bowl ad, both companies are contributing to it. So the quantity limit has gone away because the vendors are often involved at this point.
So yes, that's interesting. Nature. It's a different way to think about it. But we talk about Black Friday, but we're starting well before Black Friday, though, right? I mean, it's an end of year thing.
Oh, of course, of course. Yeah. And then we have Cyber Monday, and all of these sales are reflected across a plethora of channels, and that actually leads to kind of something everyone should think about in terms of the schedule. This year, especially, is interesting. Sorry, it happens every 7 years or whatever, but this year we have a very short period between Thanksgiving and Christmas. So I know we have an economic release coming out, retail sales. It's going to cover a bunch of information about November, but if you were to look at that release, you're not really getting the full picture for the holiday sales.
Yeah. So if you're thinking about this year, I'd love to get your thoughts on how you're looking at this year. And if we look at some basic, like how's the consumer doing this year, right?
Sure.
Like fairly confident, unemployment's still super low, wages have come back. Debt isn't particularly high. So that should all point to a pretty active, successful holiday shopping season. But didn't we feel the same way last year? And it wasn't a great year last year.
We did. And this year has a couple other considerations. When you kind of sprinkle in, we're not going to go off on a tangent here, but when you sprinkle in some of
we're all about tangents. Yeah.
Fine.
Yeah. We run around tangents.
It's kind of the basis of the podcast.
Yeah. Point taken. But when we think about the impact of trade and sort of that direct impact on trade on industrial production, that plus some interesting base effects in what's going on.
And when you're referring to trade, you're talking about the trade war and tariffs and everything that's been going on.
Trade war, tariffs, the whole thing that's kind of since the middle of 18.
Exactly.
Right?
Very
nothing new. Everyone kind of knows it. There's nothing I'm going to add there, that's for sure. But it's going on. And so when I think about what that has impacted, we kind of look at the manufacturing sector, so not the retail sector, is having a crummy run, right? This is material. It's very similar. I think of it a lot like 2014. Oil prices took a dive. The sector was the industrial sector, not the economy. The industrial sector was sort of in recession for 5 or 6 quarters around there, and we kind of looked at GDP and we only saw a couple tenths come off of GDP. So the point is, there's focus on the on industrial production. But what I think people are perhaps underestimating for this quarter is the impact on the consumer. And so what connects those two things is you have a group of people who are now in, probably the 12th real month of when it impacted them, post the August 1 tariff increases, and they're sitting there and they're saying, I know my companies aren't spending. Mm-hmm. We know that the hiring is not happening. Didn't say there were layoffs, right?
Yeah.
We know their hiring is not happening, and the consumer confidence, while it's high, has stopped going up.
Yeah.
So the second derivative has changed there. So when I sit there and I look at that, you say, okay, but give me something tangible I can talk about around that. So then you kind of take a look at Q2, Q3 of this year, and you sort of look at it and you say, my gosh, consumption as a measurement has been very high. It's basically outstripped income growth pretty materially.
That's a very important point.
And that's been great. But then we sort of had this drop in the stock market in August. We had the new tariff. What was it, on August 1? I think August 1st.
September 1st, yeah.
But sorry. The announcement kind of spooked the consumer confidence.
Right.
Then they went into effect. So the August 1 announcement is kind of how I think about impacting the consumer. Clearly,
and we still have potentially December 15th hanging out there, which is 100%. Directly on consumer goods, too.
100%.
It's not our base case that happens, but it's still a risk to the consumer.
Right. So now when you look at the retail sales, again, not the level, but the rate of growth, that's come off. And so when I think about, I think about the control measure, and I think about non-durable goods component, that's going to do like less than a 3. We did a 6+ before, right? So when the bottom line out of all
but also that's a very important point. Well, things are not disastrous.
No.
Your point of rate of change is important because when you decelerate from a very high rate, that next level of numbers looks a lot worse.
Totally.
And, whether it's GDP or whether it's a Target or Walmart's earnings.
Yeah. So now let's talk about
and especially stock markets are supposed to be forward looking.
Bingo. And right there you hit the nail on the head, because what we have now is we have Q4, we have a really weird base effect in it because we had high numbers, right? Then Q1 sank, right? Then we had 2 really high Q2 and Q3. So in that period, real consumption was like a 3.5 to 4. I think it was 3.7 is real number. It doesn't matter, 3.5 to 4. So now if we get into the first quarter, the rate is going to be like 2.5, maybe. Mm-hmm. So then when I say, how am I going to make my GDP number? Because Q4 consumer spending matters more than GDP. I'm sitting here and saying we might struggle to get to a 2. Yeah. And
right.
so that's
and also a point that we've made in previous podcasts is because of the tariffs, companies basically bought a year to 2 years of inventory to get ahead of the tariffs. So first quarter inventory build, no matter what happens with the trade negotiations, is going to be worse than it was a year ago, right?
It's going to be worse on a volume basis.
Because you've already bought everything you need. Yeah.
Worse on a volume basis, the tariffs go through, the dollar basis will be less impacted. But yes, and so you're sitting here and it's a little bit of a weird setup where the consumer kind of carried things for the first part of the year. Q4, let's just say we converge back to income growth. Right?
Okay.
No one's calling for some crazy recession, right? Yeah. Everyone's being very simplistic about it.
Okay. And this week we get those numbers for October.
Yep. So converges back to income growth. We're kind of looking at a 2%-ish GDP number, and then now we're getting out of sort of what we can kind of put our finger on into a little bit of speculation. But we can talk about that and say, geez, if these tariffs aren't rolled back, now we're going to see actual PPI, so the producer prices actually start to go up, and we'll see higher inflation numbers for the first 3 or 4 months of the year. So a slower economy plus higher inflation and a stock market that's, this steps out of my area of expertise and probably more to you guys, but in a market that's sort of thinking, oh, geez, the Fed is going to, it may actually be stopping for now. That might be a little bit of an ugly combination.
But the PPI, so Matt, just in terms of the PPI, you're seeing that lifting, but does that really get passed through? We've seen some pretty interesting dynamics on the pass-through and how retailers have dealt with that.
You're 100% right. And what we've seen to date is there's a couple categories of wholesaler margins in the PPI, which is basically measuring how much money wholesalers make, the distributors. And what we've seen is that those have collapsed. So because the guy importing it from X country to our country has eaten the tariffs. So you see those margins go down, so PPI is lower. And even though it's lower, so that's bringing down your PCE number, which the Fed looks at for inflation, but we may be getting to the point where that starts to actually pass through. So that those margin numbers coming off, plus the tariffs, plus a little bit of healthcare and housing and CPI, and the PCE numbers probably will see some sort of a bump up. Doesn't have to be extreme, it just kind of puts everyone in sort of a bad spot with a lower GDP number and the Fed on pause.
So at an individual company level, the various companies that you look at, what kind of company is able to say, hey, no, you guy that I'm buying it from, I'm not paying you for the tariff, you have to eat it? And what kind of company is at risk if these tariffs remain of having to either absorb it and lose money, or try to pass it on to the consumer?
I think at the end of the day, there will be a lot of splitting the difference. Right
Makes
now,
sense.
the importer exporters have taken a lot of it. The companies that don't necessarily have pricing power but have volume power, I think, will do okay. So the Walmarts of the world, for example, they're known for low price. They will pass through if they have to, but they'll say that, guys, you gotta. We're running huge runs for you. We'll go from there. So I think volume enabled companies and folks that have some of the smaller vendors that have solid pricing power because they have a product and combined with a service. I think those guys will do better.
Yeah, that's very interesting, and maybe that's a good time to take a break and set up for the next segment where we can talk about how, especially because of the brick and mortar and now online, the consumer behavior has changed a lot. So maybe we'll get to that. So we'll take a break here, and we'll be back with the HPS Macrocast.
Markets Policy Partners provide sophisticated financial market analysis that is independent, accessible, and actionable for a broad audience. Learn more at marketspolicy.com.
All right, we're back with the HPS Macrocast. So, Matt, what we started to get into, would really love to spend a little bit of time talking about is the changing landscape of retail, because there's a lot going on there in cyber land and in brick and mortar land. You have cyber retailers like Amazon putting up brick and mortar shops, and you have huge retailers like Walmart and others who are brick and mortar traditional, who are really trying really hard to execute on their digital strategies, and in some cases doing pretty well. So how does that play at this time of year in particular, and what about the changing nature of that sector?
Sure. I mean, we can talk about how it changes the top line, which is sort of what people always focus on, how much you sell.
Yeah.
And of course, whether it's a big retailer, again, I'll use the big guys because they do a lot of great work around this, the Walmarts of the world, actually getting more online customers, more app sales, and expanding their brands to potentially higher price point items that they sell to a slightly different consumer online. They're able to sort of segment their consumers. The Home Depots of the world being very thoughtful about how they merchandise their stores and making sure they have an extra set of assortment online for stuff that's purchased less frequently, but people don't necessarily have to peel off and go to Amazon because they can still specialize but offer a lot more things. So more choices, more price because you're selling items or accessing a consumer you wouldn't necessarily access, and more opportunity to get in touch with the customer and be in front of them and interact with them on a faster basis. When it comes to how much money they make on these things, it's kind of a whole nother story.
Mm-hmm.
So just because you get top line dollars, usually good, but not always the best, because they might come at a smaller margin than the dollars you had before, and investors may or may not like that. So they tend to take many years to decide whether they like it. But
is there a trend? Is there a trend in how much tolerance there is for margins getting squeezed?
It's funny. The trend was pretty negative, and now people are starting to be willing to pay the higher multiples for the growth within retailers who historically didn't have that growth. So if you had large retailer X and online sales were growing 100 or 50, 300, 1,000%, but they were less than 1% of sales, no one cared, right? And now when we're starting, I kind of feel like the tipping point is when we get to sort of 15, 20% of top line, and it's growing at no longer that rate, but it's growing at somewhere between 20 and 30, people tend to actually subscribe to that value proposition and figure, hey, they're going to make money in the future. Amazon gets the same benefit of the doubt. Amazon's profitability is probably nowhere near what it could be, but they reinvest that money so they can continue to grow faster. Nothing wrong with that. It's a choice. The market seems to like it. They're doing a great job. All these businesses are very thoughtful. And then you sort of see the niche stuff where people say, the conversion from concern to hope I think that was evidenced on, we had Target report on earlier in the month.
Mm-hmm. Target's an interesting base case scenario for us to talk about. Yeah.
They were, and look, guys, they have a lot of stores, a lot of overhead. They've historically sold stuff that was general merchandise, but at the same time tried to do, they do create collections. They do merchandise their stuff. They have certain fashion designers they work with, etc. So they really make an effort to have specific views on products and your home and positioning. But at the same time, they have to sell holiday greeting cards and a bunch of vacuum cleaners, right? Because it's volume for them. There's nothing wrong with that. And so what was interesting was they actually pointed out on the most recent call that their business plan, which involves a lot of, buy it and pick it up at the store.
That's what I was going to ask you. Yeah,
is actually profitable.
So it is profitable.
Didn't expect that.
I saw that people really liked it, but I wasn't aware whether they make money off of it.
It seems like, and they're according to them, that they're starting to make money on it, and that's very different from I ordered it, and I had to spin up a whole distribution warehouse or ship it from my store and pay FedEx or whomever to get it to you. So that kind of retail is less profitable. So you're seeing the ebbs and flows of these things start to work out, and you're seeing success with some of the larger guys stabilizing those businesses and doing a better job, and they've spent billions of dollars, but they have put a lot of effort into it. And you see a lot of that's driven by the change in how they access the consumer. Those companies that I mentioned, they have hundreds of people in their search engine optimization teams, in their data teams, and so they're actually starting to run their business as online businesses integrated with the general planning. Before it was, go ahead.
I think it's kind of interesting. I mean, it's only around the holiday season, but from a psychological, sociological standpoint, if I buy all my Christmas presents online at Amazon, all the boxes arrives. So the kids can open them, or my wife can open them, and then it's not a secret. So it's actually very interesting to buy it from Target and then go pick it up yourself.
And then Santa can bring them.
You can get it the next day, or you can get it a week later if it's not any rush, but no one's going to see what I bought.
And it doesn't detract, for certain people, it doesn't detract from the convenience. I mean, at the end of the day,
because there is a Target close to pretty much everybody. There's a Walmart close to pretty much everybody.
Yeah, the trick with retail, until online retail came out, was you put a bunch of stuff in a place, and as long as you had people come through fast enough, you didn't have to worry about getting it to them. They drove to you to pick up the stuff. It's obvious, but it's really important. So now people aren't willing to drive to pick up stuff without other value propositions. So at first they gave them some money off, but then you don't make money on that.
Right.
And now they're saying, hey, you're out anyway, your Target run and done, right?
Yep.
They're doing a great job. You're out anyway, you're doing X, Y, and Z. Just order online. You can actually pick it up the same day. You don't have to worry about waiting for it or pick an Amazon day or whatever. So people have said, oh, actually, that's a value proposition for me. So now they're willing to spend effectively the gas money and their time to go pick it up.
No, I think about it. I've had to stop at Target a few times because my wife asked me to pick up 3 very unique and very different things. And it took me 45 minutes to find these unique different things. If I had able to just click and had somebody waiting, I would have to pick them up.
100%.
Hey, 100%. Can I ask you about some other, a couple of other, big names out there for this time of year? Like one is Macy's, right? If you woke up on Thursday morning, you saw the Macy's Day Parade, and so it made a lot of sense for Macy's. So how's Macy's and other department stores competing? And the second is we just saw the news today that Tiffany's was being purchased by LVMH Group. Luxury is in a different category. Does this time of year is it even more important for them at this time of year?
Yeah, that's a great question.
Sure. So just starting on the soft lines, guys, i.e., folks that sell clothes.
Yeah.
We're seeing there's a plethora of business models. Macy's is one big department store model. But we're seeing them make some very important changes as well. So I don't want to generalize with them, but let's talk about businesses like Nordstrom's, right? Family operated, not obviously it's a public company, but family operated. And when you look at their new store formats, they're experimenting and they're putting real bets on the table. And I think investors actually do appreciate that they're making real bets. An example of that would be if you open a smaller format store, then you are going to have They've done a couple new ones in the New York area where they have bars and food, literally bars and food on each level of the store. So they're trying to change the shopping experience. If I look at what Bloomingdale's has done in their newer stores, they have immersive experiences in the kids sections, right? They can partner with Disney and other people to actually do thoughtful things, and they're making it a little bit more of an event to go shopping, so it's actually something you would do with, for example, with your kids. So when those who are reinvesting, and by the way, Bloomingdale's is a subsidiary of Macy's, so those who are reinvesting in those stores because it makes sense and following those trends, they're doing a decent job of making the right steps. But those guys also have a formula that they stick to, which has served them. For example, Nordstrom's tends to assort very tight collections, and what I mean by that is XYZ designer has 30 pieces. Nordstrom only sells 5 of those 30, right? Because they made that choice for you. That's their shtick.
Yeah.
Nothing wrong with it. It is what it is. Bloomingdale's might have an entire collection from a designer. So everyone's sort of picking their piece, but they're actually doing thoughtful things. So they are turning in a brick and mortar retail experience into much more of what you would buy if you shopped some of the online specialty stores that we're kind of used to shopping, or that the newer generation of folks is enjoying. They're actually trying to bring that into the tangible world, and I think they have a good shot on those. So that's one. That's to address your first question.
Tiffany's luxury.
Yeah, no, luxury.
Yeah.
So luxury is always luxury has a lot of variables in it. Obviously, spending level variables. Of course, Christmas is important to luxury retailers, especially in the U.S. A little bit less clearly. The same way that Chinese New Year, Golden Week, etc., are important to luxury. So I would argue, on a global basis, that the importance of Christmas is probably a little more diffused than than otherwise. But nonetheless, they're important holidays. When I think about what they're doing with their business models and why they're consolidating, a lot of them have thoughtful brand leading marketing folks. And I'll mix and match a little bit with luxury just to sort of illustrate a point. Let's just not talk quite about luxury, but let's talk about someone like L'Oreal or Estee Lauder, right? So those guys have, when we think about the margins they make probably a profit 80 cents on the dollar of what they've built, right? So they sell you a box for $1. It only costs them really 20 cents to put the box in, ship it to the store, formulate it, get it approved, whatever. Yeah. So you say, my gosh, they make a huge margin, right? That's their gross margin level. When you look at what they spend on marketing, though, they'll spend another 20 or 30% of that on marketing to make you think it's worth the dollar you spend, right? And so luxury has a very interesting, they have more, I'll call it ammunition in their dollars, but they have to spend more on their brand. So the question is, what is the trade-off between what they're spending and what they're actually going to get back? So when you develop brands like Tiffany's, obviously namesake brand, around for years, those guys can be brought to a larger group of consumers with regional preferences. When I look at what LVMH does for their standard, I'm sure everyone's seen the purses or the luggage, the standard LV stuff. They've managed to maintain a luxury logo around that, but there's many folks across all income levels that would consume that product or aspire to consume that product. So what they're doing, for example, LVMH is sponsoring characters and levels within certain of these online gaming platforms. So they're spending money in new places to make sure to drive volume.
That's
and I think they're doing thoughtful things. So when I look at something like Tiffany, how would I drive the volume? They've always had very high-end stuff on the high end, right? I know that's an obvious statement, but they've always struggled, in my view, on some of the low-end stuff. Remember they had the necklaces that were in the shape of a key for a while? That was popular, right? That whole thing. And they had a sterling silver collection, but they never really pumped the volume on that. So when I think about what a company, what this combination might look like, it would be using some of the skills around global luxury and making sure we're accessing that whole integral under the income curve in the way they're going to push it. So I would imagine they'll generate some value, but they're certainly paying a pretty penny. But that's how luxury is evolving. They're thinking about getting more people, but also making sure to spend to get their brand. So it's a tough trade-off.
Matt, can't tell you how much we appreciate you joining us for the special Black Friday edition. I hope we make it a tradition.
All right,
that you're
sounds
with
like
us
a plan
on Black Friday. Yeah.
Sounds like a plan.
It'll be a lot of fun. And get you in the
All right,
studio one
Dylan.
of these days, too.
Of course. Thanks for having me. Have a wonderful Thanksgiving.
You too. Take care.
All right. Bye.
All right. Hey, let's take a quick break, and we'll look ahead to next week.
On the first Friday of every month, HPS analyzes the latest jobs and labor market data in a digestible format. Sign up for our reports at hamiltonplacestrategies.com or on Twitter at HPS Insight.
All right, we're back on the Macrocast for the special Black Friday edition, and where we established that John Fagan has nothing to say about retail because he doesn't actually buy anything.
I am the worst consumer. It's downright un-American, my poor level of consumption. I aim to fix that.
You got to get in the game, man. Get in the game.
Well, tell your Skechers story.
There was an article in the Post or something that said Skechers in the business section. Skechers is exploring new possibilities with in going from a cool brand to exploring lame dads, and then I looked down at my feet and I said, I think those may be Skechers. And that's exactly what they were.
Target market.
I was like, they're obviously just cleaning up in the lame dads demographic.
They're very comfortable,
yeah,
though,
they
right?
really are. So, thank you, Skechers.
Well, we're going to have we're going to learn some things next. We will learn about how Black Friday and Cyber Monday went, and if those bear any, if there are any signals on the broader markets and broader economy from that. But we're also going to get the big jobs report on Friday as well.
Yep. So it's Jobs Friday, so it's kind of our favorite podcast of the month. Other than that, we also get a Bank of Canada meeting, but there was a kind of earlier in the month expectations that they might cut and kind of have to follow the rest of the global central banks down. But Governor Pelosi
Just to troll Trump,
exactly.
Do you think? Yeah.
But kind of Governor Pelosi put a little bit of cold water on that. So there's still expectations for first quarter cuts, but not anymore this next week. And then, which never was an important data point, but now we get the U.S. balance of trade and also the Chinese balance of trade. And as of today, Monday, November 25th, we don't have a deal, so we'll see whether this data point matters come next week.
Just a really quick aside on the central bank thing, the Bank of Canada, the expectations for rate cuts have come off, and that is really consistent with some of the commentary we've heard from the European Central Bank under the newly minted President Lagarde, and from the commentary from the Bank of Japan,
Great
again,
point. Yep.
looking at basically saying, not we're out of bullets, no central banker would ever say that, but saying things along the line of the new mix of stimulus really has to include fiscal. The understanding is that in Japan and Europe and other places where they've got negative interest rates, they may have, they may well be into the diminishing marginal returns of that additional rate cut and trying to cast around. So it's a paradigm shift in central banks, and obviously the Fed is on hold, but the market doesn't necessarily believe that's going to last. The futures market is pricing in almost 2 full rate cuts next year. And so we've talked about the end of this year with retail looking pretty solid, but as Matt said, casting ahead to next year, there's some clouds on the horizon, and the bond market is braced for, is basically priced consistent with some pretty soft outcomes. Yeah.
Well, we're going to have we'll have some indications next week to see where we think that'll go. I'm going to wish you guys a terrific Thanksgiving, and thanks for doing this podcast.
Thank you. We're thankful for this podcast, and it's and to you and yours as well. Enjoy a great meal and
lots
time
to
with
be
family.
thankful for. Yeah, we're not really good at thanking all of our production support. We have at HPS at HPS here as well too. And
Ariel is the best producer we have.
A magnificent team all around.
Thank you all. Hope everyone has had a wonderful Thanksgiving. We will see you on Jobs Friday. Have a great weekend.
Thank you for listening to the HPS Macrocast. Please remember to subscribe, rate, and share. Find more from Hamilton Place Strategies at hamiltonplacestrategies.com and follow Tony Fratto on Twitter at Tony Fratto. Learn more about John Fagan, Brendan Walsh, and the work they do at Markets Policy Partners by visiting marketspolicy.com.